Great. Hello, and welcome to our webinar. Let's get started. I apologize that we're a couple minutes late here. So we'd like to welcome you to our webinar today, and we're happy to partner again with one of our most popular speakers to bring you this webinar today on option strategies and technical analysis. My name is Gina Bocayas, and I'm on the management team of Regal Securities, which is the parent company of eOption and its sister company, Investrade. A few housekeeping matters. The session today will last approximately 1 hour. We ask that you take a moment to locate the Q&A box on your screen. Please enter all of your questions here throughout the webinar, and our speaker will answer them at the end of his presentation. And to tell you a bit about eOption, we offer you many options for your trading. You can trade stocks, exchange-traded funds, bonds, and mutual funds. And of course, as our name implies, we also offer options trading, and we enjoy teaching people how to trade them. We offer you some of the lowest rates in the country, including zero commission on stock trades and ETFs, and options are just 10 cents per contract plus $1.99 per trade. We also offer an easy-to-use trading platform as well as free trading tools to help you spot option trading opportunities. Our parent company, Regal Securities, has been servicing investors since 1976. Also, a recording of this video will be available on eOption's YouTube channel in the next few days, along with an extensive library of trading videos. So we encourage you to take a moment and subscribe today. And before we start, I'd like to turn your attention to the screen to the eOption disclaimer that you'll see. We'd like to make it clear that this webinar is for educational purposes only and is not recommendations or personalized investment advice. If you go to the fourth bullet point, you'll see that options do carry a high level of risk and are not suitable for all investors. There's a booklet there called Characteristics and Risks of Standardized Options. And you can go to the website there or send us an email at support@eoption.com, and we're happy to send you an updated booklet. Now, this booklet was just updated by the industry at the end of March, so you will receive the latest and greatest if you go to that link. So I'd like to turn our attention to our speaker now, Teddy Keckstadt. He's done many webinars for us, and we'd like to welcome him back today. Teddy is a professional trader and has over 30 years of trading experience. He traded at the Chicago Board of Options Exchange, Chicago Mercantile Exchange, and Chicago Board of Trade for 21 years and has been an institutional market analyst for over 25 years. He serves as president of Forex Trading Unlocked and is the author of High Probable Japanese Candlestick Patterns. He has a degree in finance from DePaul University as well. And without further ado, I'll turn it over to Teddy Keckstadt. Thank you.
Thank you, Gina, and thank you all of you for attending this webinar today. So we have a lot to talk about, and we had a little technical difficulties, had to swap computers, so if you may have to fumble around a little bit because there was a couple screens that weren't exactly ready to go. All right, so you should be able to see this little chart here. That's not what we want first. Okay, we have the eoption.com website pulled up. So I'm going to pull up my little client login here. It's very easy to use this. As an account holder, you would be using live trading, but we're using this for the demo, and you can't see my password. So we put this in real quick. You can see this is very easy, just like any other type of login thing. Once you have your set up, the people option can help you with doing that, whether it's real or not. Okay, so where are we going here? Why it should be loading up. Okay. There we go. Now it's spinning. Sorry, I had this all loaded up on the other computer, so we have to bear in mind. So we're going to be talking about different ways of applying option strategies to technical analysis, and we're going to be using the eOption trading platform to place some different option strategies on the platform for different ideas that we come up with. So, and we're going to start by first talking about the different types of strategies we're going to use. So for the scenarios, if we find a situation that is very, very bullish, we'll be talking about using a long call strategy or a long straddle strategy. A straddle is when you're buying simultaneously a put and a call, the same strike price and same expiration price. If you're buying a long call, that's being synthetically long the market, where instead of buying the stock and owning the equity, you own the right to buy the stock at a certain strike price, which would be that would be the price you have the right to buy the stock at. And if you're most bearish on the situation that we talk about today, we're going to be talking about where you execute a long put. It's the opposite of a call. So that's being synthetically short the market or being long a straddle as well. Okay, because you do the straddle, buying both a put and call. So we'll talk about that in more depth once we get to the situations. And then if you're bullish or bearish and you have a bit of time before expiration and for a short to medium type move, then we'll talk about implement credit spread, which you can use in all these scenarios, but there's certain times where it becomes a little bit better to use. All right, so here you can see we have the e-option trading platform up here. You have your account summary. We're going to go and put it on the trading tab. And this is where we're going to figure out which orders we're going to initiate. Okay, so this is pulling this up, so we'll be ready for when we get after we look at the market. So, and as that's pulling up, we're going to go and we're going to pull up our chart here. So we're going to use this, change the symbol here. And we're going to go, with one of the stocks that was actually highlighted on the action platform for stocks that are moving today. So what we have here is Schwab short-term ETF. Okay, so now this one here, you can see on the daily basis right now, it's lower since it's red. When it's red, it's going down. When it's green, it's a positive day. Now, overall, this trend right here, you can see we have two moving averages here. We have a 200-day and we have a moving average. Now, typically, when you have the short term below the longer term, that is a bearish sign. Okay, so right now, if you look at these averages, the 200 starting to flat out, but it's basically been trending lower. The 50-day has been going sideways. It's trying to go higher, but as you can see, it hasn't crossed above. Now, usually when you have a crossover, that indicates a change in trend. Now, the thing with moving averages, though, is that they're very lagging. So this does give us a good view, though, of the fact that this market is possibly, at least at the very most likely, neutral in this outlook. Another thing that we have going on here is we're going to talk about some patterns today, which makes it really easy to try and identify trades. Now, see this top up here? Right here, this is what would be top of this move. As you can see, this we had from this low to this swing high. This here is what we're going to call the head. And then we're going to put over here, we're going to put an S for shoulder. So we're going to talk about how a head and shoulders pattern can be traded with options, because that's what we have going on here. As you can see, as I label this, there's two shoulders, which are two swing highs that are lower than this middle high, hence the term head and shoulders. Now, when you have a situation like this forming, you combine the shoulders, and that gives you what's called a neckline. And when that neckline gets violated, like it did over the past couple sessions on Monday and Tuesday, that indicates right there that we have a short-term confirmation of a lower trending market, meaning that this market had been trading higher from the beginning of March all the way up until the end of March. And now we have a short-term correction. However, this correction isn't something that was just pulling back a little bit like it did first here going into the beginning of April. And then you can see how we rallied here. But this is where we stalled. And that's why it's considering a turning point pattern. Okay, so right now this gives us a good idea of direction. And the direction is that right now we should see a short-term continuation of the trend for at least the next, I would say, 1 to 2 weeks. Okay. Now, one more thing to also look at is that we have these gaps here. You can see how the market had a big move higher right there, and also right here, where between the sessions, this is something with stocks that you can see happen a lot of times, not just on a daily, but from the Friday to a Monday. And these are big things that traders look for, because when you have these gaps, typically they get filled. It's an old trader adage. Okay, so now we're going to pull up this on the eoption.com trading site right here and take a look at where the options are at right now. So we already know that we have a negative situation happening in this stock right now. And we also know that it's right at the beginning where the neckline is. Sorry for the little bit of slowness here, but using the laptop to stream this webinar versus a desktop today. All right, so we have SCHO already entered in here. As you can see, the stock price is here at 48.53. Okay, so if we were to buy a put right now, remember that when we started the webinar, I said for most bearish situations, we would be looking at a long put, a long straddle, or potentially a credit spread. So first thing we're going to do is we are going to look at the simple trade, which is to just buy a put. Okay, so now when you do that, what you're going to do is you're going to take the situation here where it says add option, you click on that. Okay, so now once you do that and you have your symbol right here, SCHO, you already know what market you're looking at. Here you start add an option, which is it's going to be one trade that you're going to execute. Okay, and then it's going to be a buy to open. Okay, so you click on the buy to open right there. So now you can see you have option, buy to open. We're going to just do it one quantity for this example. Okay, and for expiration, we're going to go into, since it's already the middle of April, we're going to go into the May option. So it's right around the middle of the month was when we have expiration. So you're going to have a good 4 weeks for this trade to put on. Then for the strike price, we know that right now the market's trading at 48.53. Okay, so we want to have a strike price that would either be at the money, which would ideally be, if it was at $48, there'd be a 48 strike price, but there's probably a 48.5 also. So we'll see what the strike prices are there. All right, so we have 48 and we have 49. Okay, so that would be in between those two. So if we buy the 48, then it's a little bit, it's a half a cent, it's a half a dollar out of the money. Okay, if we buy the 49, it's a half a dollar in the money. Now, I would suggest when you're doing something like this that you buy the at the money or the in the money put. Okay, so we're going to use the $49 strike price, not the 48. The reason being is that you already have some premium for where the market's at. So if the market never moved, you're always holding that premium of where the 50 cents from the $49 strike price down to 48.5. So there's always going to be some premium there on that option. All right, and now we put it as a put. So now you want to make sure you're clear. You got a buy to open, quantity 1, May expiration, $49 strike price, and put is the option. Okay, and you can see what the pricing is right there. So we're going to execute this trade. We hit the verify. And right now it gives you the estimated cost of $85. Okay, it gives you the commission price, all the commission. There's certain legal commissions they have to pay for the exchanges, has nothing to do with the option. And then your total cost of the option is there. You can confirm the order, and then boom, you hear a little sound, and that means ding, your trade has been executed. So the way you can look at that is you go back to your account summary, and you can see that we have, for this trade that we looked at, one put purchased right now, and it tells you your P&L of value. Now remember, there's a bid and an ask spread on options, so you're always buying the bid and selling the ask. Okay, or, excuse me. So you're going to always have that spread against you on as far as the market. So if we were to simultaneously buy it and then sell it, you're going to lose that spread getting in and out. But you don't need very much movement because this is already in the money. So if this stock drops just even like 10 cents or 25 cents, you're already going to be showing some sort of a break even or a slight profit on the option. Now let's take a look at how we execute the other options. Remember that when we looked at this stock, the head shoulders that just right now it fell through today with a confirmation. So especially with the close, like we have the 200-day moving average. See how this was support here? This became the first part of our neckline. A lot of times averages become support or resistance depending on where the market's good, if it's rallying into it or falling down, meaning breaking into it. So this is where it came and found support. Here it fell short of hitting that, okay, and found support, but now see how it failed, and now here we are riding that lower angling 200 moving day average. And if we get below that, especially close below the 50, that would really set up our negative sell signal. And think about too, is we got the $49 strike price. So let's put that into perspective for you for what we're doing here. So we have the $49 put. Okay. or basically 49. Let me clean that up so it's clear in the video. There we go. Okay. And executed the trade right here, basically where the market is at right now. So let's put this right to here, and I'll set this to 48. I think it was 48.53. All right. Okay. So you can see that right now we're right there where we executed the trade. We don't have much of a move here that we are needed to start to gain a nice profit. Okay. And we have this gap here. So let's say we get down to fill this gap right here. That's right here at 48.20. Okay, so that would be over $1 move from where we're executing the price. So let's go back to our E option. All right, now let's go to trading again. So we know that our put, if we get $1.50 move there, we're going to get a nice amount of profit right away, especially because we have the head and shoulders sell signal, and we also have the fact that we have gaps below also that need to be filled. Okay, so now let's get to the trading screen. Sorry, things are running really slow on this, folks. Okay, there we go. All right, so now we're going to do another trade. So we're going to do a $49 buy to open, one put. Actually, now we're going to go down to the 48. Since we're going to do a straddle, we're going to go down to 48. Because no matter what, the call will be in the money then. Okay, so we got one right there, and now we're going to add another option. We're going to do a buy to open, and then we're going to do the May. And remember, when you do a straddle, you're doing the same strike price. So both of these are 48, same expiration month, only this time we're going to put a call on. Okay. So now, just to be clear, we have two options that we're buying to open. We're doing a quantity of one. For it to be a straddle, it has to be the same quantity. Reason being, if you don't, it's not a straddle anymore. It's a different strategy. And then the expiration, once again, has to be the same. Then we have the strike price and the put and call. So we verify the trade. Now this one, if the market goes nowhere, all you really lose is time decay. Now, when the market goes up, you're going to make money on the call side of the spread, and when the market goes down, you'll be up money on the put side of the spread. Now, in this case, we're looking for the market to go. We're looking for it to move, period, which is the biggest thing to begin with because we already have a put. But in this way, we're looking for it to also just move. So we don't care if it goes the other way, if it rallies, as long as it moves, especially like $1.50 or more, which we think it will already have $1.50 move to the downside, you have a chance for profitability. So here, once again, it gives you, okay. I don't know why that got rejected. Okay, let's see. There we go. Okay, there we go. I waited too long on that one. The market moves. So that's why you got to check it and then hit it, because otherwise, if we can't hit the markets, you just learned something about the trading platform there. The market had moved already a couple pennies, and those options had changed pricing. So he had to verify a new trading price. All right, now let's go back to our account summary. And now you can see that we have both the put, the single put, okay, that's the 49 strike price. And then we also have the $48 put and the $48 call, okay? So now for those, you can see also the position as far as what you are as far as your P&L, okay? And you have your average open price, your quantities, and it also has your previous close and last. So this will all change as you move forward in the trade, okay? So now we're going to do, we're going to move on to another stock, okay? So now we're going to go to UTWO. UTWO. Okay, here we have yet another head and shoulders. I don't know, let's see if you can, if you've been paying attention, if you can see this. I'll make the screen a little bit wider there. Okay, so now with this one, let's get the UTWO. We'll get the trading up here, so it's ready for when we want to trade it. There we go. All right. UTWO. Enter that there, and then we'll also enter it up here also. Okay, make sure there's no option positions in here, but we will do add an option right there just to have something ready. So we're all armed and ready in case we want to take a trade here on the UTWO. Okay. All right. So the UTWO right here, we have, once again, we have a head and shoulders forming. Okay. And let me just check something real quick here. Okay. All right. Okay. All right. So here's our text. So up here, just like before, we have our head. Okay. And then we're going to have over here, we have a shoulder. And then over here, we have another shoulder. Okay, now here, the line goes down like this. So when this happens, what you do is you just take a horizontal from the lower swing low, and that is your neckline right there. As you can see, yesterday it settled right on it, and today it's trading right below it. We have the 50 day moving average right there. And oh, look at what we have here. Now, it's funny how the first stock we looked at was a brokerage stock, and now we're looking at an ETF, a treasury ETF. Now, we all know what happened with interest rates over the past couple of, or basically month or so, month and a half. In March, all of a sudden, yields started dropping significantly, even though the Fed had been raising. They even raised rates in the middle of it. And we had a pullback in yields. Now, this is an ETF notes. This is bond reflectionary. So this is a way you can look at a trading like the interest rate yield curve without being involved in those derivatives. So in this case, once again, we have a head and shoulders. We're coming out and we're right on this line here. So let's go back to our trading right here. Okay, what was the price there? Sorry about that. So we were trading right around 48.88. Okay, so for this one here, we want to look at to buy to open once again, and we're going to do a put. We're going to use the May expiration. Okay, and then we're going to use the 49. And this is going to be a put. Remember, we're looking for the market to go down. We are bearish. Okay, now we're going to execute a straddle on this, but we're also going to add a credit spread to this one as well. Okay, I could have done on the last example, but because we had a little delay in getting forward, we didn't have time to get that all in. All right, so now we verify the trade. And here it is. It gives you the option price. Estimated cost is $75, $77.16 with fees. Ding, ding, ding. There we go. Okay, now what we're going to do is we're going to do a straddle. So we're going to do another buy to open. We're going to do another May. Remember, the expiration for straddles must be the same. And then the strike price needs to be the same too. So for this one, since we're looking at the market going lower, we're going to keep the 49 there, and then we're going to use the $48. Oops, sorry, 40, excuse me. 48. There we go. All right. So we have the $48 call and put right here. So we're going to use these strike prices right here. Get the pricing. We get the verification. So this spread estimated cost is going to be $219 for this to occur. Okay, now we're going to do one more thing. So in this case, a credit spread is where you end up taking in money from the simultaneous buying and selling of one option where you have one type of option, meaning calls or puts. In this case, we're going to use calls for both. So we got call on that one. we have call on that one. And then you want to have it where you're going to get a credit. So that means that you're going to sell the closer strike price and buy the further out strike price. So we're going to use, in this case, we're going to use the $49 call, and we're going to use the $50 call. So now remember, they're both calls, only we're going to sell to open the more expensive one. Now the market's closer to this strike price, so that has more premium in it. This is more expensive, okay? And the further out is worth a lot less. Now first, let's take a look and see what they're trading at. Okay, so the estimated net cost, net credit, that's just the fees. Okay, so that's not really worth, the pricing's not there on that one. So let's see if we move it down one. We'll move to 48. Now here's where options become very interesting. We have we did a put, short put, and we did a buying a straddle, okay? Or excuse me, long put. So one, we are synthetically short the market. The other one, we're looking for a strong move in the market. In this case, we're looking for the market to go down as well, but the pricing needs to be there. So let's look at this. Okay, so this is rejecting the order, which it shouldn't be. Both may. Sell to open, buy to open, 48. Okay. Oh, I know why. Because of, we can't do this because of the put. Here's another thing, check on that. This is how you know your platform doesn't let you get into trouble. You know, can't do this. Let's go to our account summary. So remember, we had our put right here. We already have a $49 put here, okay? And we have our straddle here is fine, but this $49 put, that offsets that credit spread. So in this case, we can't do the credit spread. We'd have to use different strikes. And since they don't have $half strikes, we can't use that on this. So that's something that you just learned about, how the platform will keep you from trying to put trades on that, well, you can't work, it won't work right, or it'll throw off your other positions. So that's a nice thing to know. So, but we did have another short put and also the straddle form. So now we have, remember, once again, when you're very bullish or bearish, that's when you'll use a long call or put. In this case, it's the put because we're very bearish. And you'll also use a long straddle, okay? Now let's look at something a little bit different. So now we want to look at, how about where we have something to buy, okay? So now let's look at a company here, ACM. Okay, so in this case, we have a double bottom, okay? So a double bottom is when you have right here and right here, you have these two swing lows, and they're very close in price. Now, what makes this kind of bullish is the fact that the first bottom is slightly, oops, that's the wrong one. That's a straight line. My bad. Sorry about that, folks. I need to have a trend line. There we go. Okay. As you can see, we have bottoms that are near the same price level, but this one is slightly higher. So now, why is this bullish? Okay, well, first of all, double bottom right off from the term, it means that we're looking for the market to rally, okay? So here we have, directionally, we're looking for the market to turn. Now, what's nice about this is that the market has been in a short-term downtrend since February. You can see the market topped out here. It made a higher move low, a lower move high, and then fell through this area, fell below 50-day moving average. Remember, these are lagging indicators, but that's also a good sign that once it's below it, that you're more likely to be bearish than bullish for a while. And it started to trade towards the 200-day. So now we're in between these two averages. Long term, the trend is higher. Long term, the 200-day moving average is confirming it. Short term, this market had been trending higher, and it set up a correction from February into March. As you can see, the 50-day moving average was ascending, it plateaued, and now is descending. And this, because once again, it's lagging. This descending here is catching up all of this that's already happened, okay? but we're above the 200. So if we get above the 50 and we're above the 200, that most likely means we'll trigger a lot of buying opportunists, excuse me, out there. So this swing high right here is very important. We get above here, and right now we have a double bottoming situation. We've also done what else? This is something else that looks good. So we have the averages that are looking kind of nice in our favor for this situation, for being a double bottom, confirming it being a buy. But here's what we have. We have this low, or lower move low. Right now it's a short-term bottom for this correction off of this high. And then what we have here is we have a higher move high. Okay, so we had this market right here, or excuse me, this stock had made this lower move high here, lower move low. And then after that, after we made this lower move low, we've made a higher move high. This high is higher than this high right here. And just so you're clear, this is a lower move high. When you have a situation like this that happens right off the bat, that starts to give you an idea that the market is becoming neutral. The market did make the higher move high, but then it fell back really quick. It's totally looking like, oh, it's a range trade situation. It very may well be. This market might go sideways for the next 6 months for all we know. However, these little indications here are saying that it's kind of likely, more likely, that we're going to spark a little challenge of resistance, meaning a little move to the upside. All right, so once we have this established, this made us neutral, then we have a higher move low, which we've obviously bounced off of. Now that is the sign of what? When you have a low, a higher move high, and a higher move low, that is the beginning of an uptrend. At least in the short term, it's confirmed. So we're going to look around the 82.5 situation here. We're going to look for a buying situation on the option.com platform here. All right, so let's go to, this was, let me see, ACM. All right, we go to trading, and we're going to go right here. Remember, we change our symbol, ACM. Now we're bullish. So we're going to get rid of these right there. Okay, so we have a new stock pulled up. We're going to add an option. And what we're going to do, we're going to buy to open once again. Remember, we're only buying options. The only time we're selling is if we do a credit spread, and this one doesn't have $half increments either, so we won't be doing that. Okay, so buy to open, quantity 1, once again, we're going to go with the May expiration, and then we're going to look at, oh, let's put up the ACM right here so we see where the market price is for the stock. It's trading at 82.53. We're going to look for a strike price here, and we do have, oh, we got some half marks. We may do a credit spread on this one. Let's get through this part first. So 82.53. So we're going to buy the 82.50 strike price call, which is pretty much at the money. Remember, we talked earlier about at the money or in the money. Now, there's times you would do out of the money, but when it comes to these situations for these strategies, you try to be in the money or at the money. Okay. So now we have, once again, buy to open, quantity 1, May expiration, 82.5 strike price, and it is a call. Remember, we're looking to be synthetically long in this market. We verify it. The cost of this trade is going to be 262.16. Jump on it, because otherwise the market might move us out like before. All right, so now we have that one confirmed. Okay, now let's do something else. Now we're going to add a straddle to this one. Now in this case, remember we did a straddle for the other two situations and we were bearish. Now we're going to be bullish and we're going to do a straddle. Remember, the only thing that matters is about straddles is that 1, you have the same expiration month. 2, you have the same exact strike price. And since this is right near that strike price, both the call and put are right there basically at the money. And remember, this is a put. You're trading both sides of the market. So if the market goes nowhere, you lose time premium. That's where the value of these options decreases. You're always going to lose time premium, but that's all you lose when the market goes sideways. Now, when you get movement, then that's a totally different story, because then you're going to be making, if the market goes up, your call gets more valuable, your put goes down in price. And conversely, if the market goes down, your put goes up in value and your call goes down in price. The relationship between these two and the distance of the move will dictate which option accelerates more, either in price going up or down, and that will indicate whether you'll make money. In this case, we're looking for a nice move. There's some gaps to be filled. Once again, we should have the opportunity to take that. Now, this is going to be $484. Okay. All right. Now, once you get the stock, now we're bullish this market, right? So if we're a bullish market, so 82.5, what would be nice is if we sell the 82.5 put and then buy back the 80 or 78.5 put. Let's see what we got going on the. So for 82.5, then we're gonna go with the 82 even. So now we're gonna go with an 80, and then we're gonna go with both with puts. Remember, we're bearish, so we're gonna do a credit spread here, and I'll explain this once we get this 82 even. Oh, we can't do 82 even. We can't do that. Oh, that's right. They're dollar while they're $2.5. Oh, they're $2.5 apart. That's why. Okay, so once again, because of the pricing situation, we wouldn't be able to get a credit spread off. So, these markets some of them are more liquid than others, and that's where you'll be able to have other opportunities. Okay, so we're going to forget about that one. This is a chance to go over another example then. That's good. All right, now let's go to another example. Okay, I have, I think there. Okay, let's see. We do have a question here. Can you group the 48 put call to file it as a straddle? Yeah, when you are doing a 48 strike price put and call, that is a straddle, as long as it has the same expiration. So I've got some of these Q&As are a little bit behind on my screen. So sorry for the late reply on that question. Okay, so now let's go to the next thing here. So now let's go look at, we did ACM, let's do AEG. AEG. Actually, let me think. I did one earlier. Let me see. This might be an example for you. Okay, the double bottom. Okay, here's a good example of the double bottom situation. Okay. All right. All right, so we have AMT here. So this situation here, you can see we have a bottom there, and then we have a bottom, whoops. We have a bottom right there. Okay, in this case, this bottom is a little lower. They are both basically about the same price. And then you can see where we have a lower move high, a lower move low, higher move high, and then we have a lower move low. So, I mean, a lot of indecision, okay? So when this happens, it looks like more neutral for the trend. And that's exactly where you're looking at when the second bottom here, because you don't have a confirmed double bottom until you get further away from it, like for instance, where it is now. And then this swing high becomes big, because this is the thing here where all of a sudden, once it breached this, it confirmed that after a higher move high and a lower move low and a higher move high, that we're most likely going to see more strength than weakness. That means a neutral higher trade. Another thing that happened is after it, right before it breached there, it crossed above the 50-day moving average. And right now it's riding here. But we've been making consecutive high move highs. We've made a higher move low. It's trending here. And as long as it continues to go higher, a call situation would look really good. Now, the nice thing about this is, let's say we do straddle, okay? If we're wrong about the bullish scenario, this market here is it's trading at $200. It has a nice move on, not necessarily on a daily basis, but on a weekly basis, and especially over the course of like 2 weeks. You pretty much have a $10, $15 to $20 move between those types of time frames. If we get a $10 to $20 move away from this spot here, the upside, the call obviously is good. If it goes down, well, then that's loser right there. But for straddle, that one looks really good and right for that. So back to the trading platform, we're gonna go look at AMT. Okay, and this one, we got some questions. I'm gonna get to those as soon as I enter these couple trades. All right, guys, definitely gonna get to them. All right, so we put in AMT. Okay. And we're gonna go buy to open once again. I'm going to put the AMT up here also. Okay, we're going to go with the May expiration. And we're going to go waiting for this to load up. Okay, so 209 last. So 210 is just above this, the market price. So we're going to go with a 210 call. It's pretty much at the money. And there we go. And we're going to do the verify. Now this is an expensive option here. It's $622, but then also realize the price that the stock is trading at $200 and some dollars. So the more expensive the stocks, like if you were trading Tesla stock, believe me, buying calls, puts in that thing, you really better want to make sure you're long on right about that position. And that's where you need to, you're not really getting your bang for your buck. Your risk reward on calls and puts in a stock like Tesla, unless you really catch a big move, is extremely high. You really need to be watching those, because the stocks we're looking at here, the volatility on them is reasonably manageable to deal with, and it's not overdone in pricing to where it takes you're getting more bang for your buck. Like, which would you rather do? Would you rather make $150 on a $250 position, or would you rather make $150 on a $50,000 position? If you got to answer, you don't know the former was better than the latter, then we really have to have another totally different webinar for you. So, because your risk reward in trading is a business, you want to make it look at your ROIs, just like why we didn't take those other credit spreads before. Okay. So now we did buy to open there. So now we're also going to do a straddle also, and then I'm going to get to the questions. All right. So, and as far as I can answer one question right now. So I was asked, where am I getting these stocks? Okay, well, the whole point of this webinar is how to apply technical analysis to option strategies. So we start off with Head and Shoulders. So I scanned for Head and Shoulders setups, and I also knew some that were already kind of in that situation. I've been watching, and so that was how I found them. I scanned for the double bottom situations as well. There's all different ways you can do that. I would consult with use their scanners and stuff, especially when it comes to patterns. I don't know how, I personally have never used theirs for patterns, so I don't know how to set that up, but they might be able to, they can obviously tell you how to do that. And so, there's also plenty of other places you can get them. Most trading platforms and analysis platforms have scanners that you can do that, especially for equities like stocks and ETFs and things like that. So very good question. So I didn't just pull these out of thin air, obviously, because these things have patterns. There's so many thousands and thousands of stocks. I couldn't just be, it would be a nightmare trying to find them all on my, so yes, there's easy ways to find these things. All right, so let's take a look at the trade here. Oops. Okay. Oops. Once put. See, there we go. All right. So put on a straddle, buying one put, all the same expiration and same strike price. This costs $1,200, just under $1,300. So we're going to place that trade right there. Okay, you got the nice ding, so you know what happened. All right, let's go to account summary. Hey, net change on the day so far with our positions. We're up almost $1. You know, yay. Okay, so here we got our P&L. You can see that we have our new trades. Okay, we have the UTWs from before. That's the AMT. We have the put and the call. Now we have the ACM as well. All right. So that looks good. Now let's see with the other questions. All right. Do you keep a notebook until all your trades will be initiated in trades, assumptions, time, date, objectives, or stop loss? Okay. As far as a notebook, well, I have so many different markets that I trade, so I have things basically on, depending on what it is, grouped through spreadsheets. And I know once I put the trades on, I don't need to monitor the stops and stuff like that, because I already have a preset where I enter them in, and I know how to adjust them on a daily or weekly basis, depending on the different market that I trade. So as far as a notebook, I do keep a log of what I'm doing when it's live, just because I do trade multiple markets. And even if you trade one, you want to know what you're doing. But I do have, when I put on trades, I always have my initial position, what I want to do, whether I'm going long or short. In this case with options, you have all kinds of different strategies you can implement. Like for instance, we're using the being long a call or a put, meaning you're taking a stance on direction. That's something, a key thing that you need to know for why you would buy that call or put. When you in these instances, we're doing at the money or just out of the money, or either at the money, in the money, or barely out of the money. So depending on the different equity. So very good questions. Yeah, I would always, while you're trading, be aware of what you're doing. If you have situations that are setting up, and one thing I want to definitely try and instill in you is don't get ahead of yourself. Okay, so for instance, like we did the head and shoulders situations, don't do things until they actually occur. Okay, so let's give you like an idea. Let's go back to the SCHO example. Remember we had the head and shoulders. Okay, so in this case here, see where this neckline is? Like today was a great day to implement the trade. Now, it had just fallen below the neckline on Monday. Could you execute the trade during the day? Yes, you could have, or yesterday, you already had taken out that line. That low had been taken out. Now, as far as today, we're right away from there. Good day to trade that, still, because it's right there near that price. If it gets away from it, obviously not. If it gets a little higher, you get a better chance in it, also possibly getting on a call at a better price. But the key is to know what your risk is, know why you're getting there, and also don't get in front of it. I have this head and shoulders forming here. Like we had this day here, we get lower. Would you want to put on the put there or put the straddle on there? Well, you could, but you know what you didn't have? You didn't have a confirmation of the head and shoulders. You didn't have a confirmation until Monday of this week when the market opened and then tagged and fell through that line and settled on that. So it was Monday when it penetrated that. That would be your first indication of pulling the trigger. Okay, but the day before, Friday, if you would have been saying, hey, the market got lower, hey, I want to get in front of this trade, that is something you should never do, because you know what happens a lot. And when I say a lot, I can't even begin to tell you how much a lot is. Instead of it coming down here and falling through here, it goes like this. And you know what that means? When that happens, you didn't have a head and shoulders pattern. The only way to have a head and shoulders pattern is if you allow it to be completed. Okay, so the same is with other types of signals. If you trade Japanese candlesticks, that was a good question of where do you find these? There's all kinds of candlestick things. In fact, do that example real quick. This will help with it. We have time for one more example. So we're going to look at ARCC. Okay, so once again here, you know what we have here? This is now a book called High Probable Japanese Candlesticks. So this is a good one to end on. This high right here, this red line right there, this is called the bearish engulfing line. Nice thing about this is the market set a low back here in March. It was correcting higher. The overall trend is lower. Okay. Now, when we came up here, we made a low move high move low. This is the high move high. That's neutral to higher trade, right? Well, yes, it is. That is definitely something that it does. However, it's butting up against this 50-day moving average, and it's still above the 200. The 200 is trending lower to flat, and the 50 is definitely trending lower. You can see how it bounced off this line. These averages sometimes become support and resistance. This would be one case of that. We have this sell signal right here, and now the market's trading here. Now look at how this is where you know that you're kind of getting tricky. We just set a higher move low. Okay, so the market is still trending.
Teddy, if I can just jump in real quick, your sound is coming across a little bit spotty.
Okay.
Do you think you can?
I didn't change anything or move, so I don't know. Okay. Can you hear it okay now? Is it better? Is it better now? Okay. So, well, anyhow, yeah. Well, I'll just finish the example up. So, okay. So with here, you can see how the market is making higher move highs and higher move lows. So if we take this out, this becomes a nice little break. So this would be one where this signal had already occurred and we have an opportunity to take advantage of it. So for ARCC, this would be a great time to put on a put. We go to trading. Sorry if the mic's getting a little spotty. I don't know. We've had a lot of technical difficulties today. So, but we're getting through it, right? Good questions. Let's see while I'm waiting for this to load. What profit ratio do you typically go for? Really good question. Okay, so for profit ratios, I usually look for, depending on the duration of the trade, if it's very short term, 2 to 1 is okay. But typically I look for a 3 or 4 to upwards of 5 to 1 trading ratio. So here, let's get this one entered here. ARCC, symbol up here. ARCC. Okay. So we're going to add an option. We're going to add a buy to open, expiration May, strike price a put. Remember, we have the sell signal. So since 1841, we're going to do an in the money $19 strike price. Remember, it's a put, and we're going to execute this. $87 on that one. Okay, and now we're also going to do another settle on this one. Buy to open, same expiration. Remember, the strike price has to be the same, 19, and we're going to do the call, and then we're going to execute that. And then we go back to our account summary. Sorry, things are slow, but using a laptop with 2 screens now and having all these things running, it's not meant to stream and do all this stuff at once. So, okay, so there we go. So we have all those trades. You got the AMT in there. You got the ARCs. You got, it's all in there right now. All the trades that we have put on there today. And believe it or not, we're flat after putting on all those trades. So you know what that means? That means that the trades that we put on right now, they are slightly positive, because when you put on a trade, you always have your spread between getting in and out that you give up from the bid and the ask spread. So, so yes, for profit ratios, great questions on that one, and especially when I would say for beginning traders, money management is the #1 thing for any business, and especially with trading. If you're going to be doing very low reward to risk ratios, you better be right a lot for one. And realize that you have to be super disciplined, and you have to be very consistent with whatever it is that you're using for that type of trading methodology. So that's why I would say use a 3 to 5 ratio, just because your winners so much outweigh your losers, you know, and when you use those ratios, you don't need to be as right as you are. I mean, you need to be more right than wrong always, but you don't need to have such a higher win rate when your reward is higher. Let's see. Do you want to know something about the companies you are trading before you put in the order, like earnings upcoming? That's a good question. Okay, so what we used today was technical analysis. Earnings is a news-driven type of trade. Just like when there's Fed Day and the interest rates come out, things like that are news driven. So for that, there are certain strategies for trading the news. As far as using technical analysis, then a moment. So you're looking to trade that day into another day, maybe 2. You're not looking for anything very long. So you're typically using shorter expiration months, and unless you are looking for earnings to give you a leg up on a trade, you know, that's a totally different story. But I don't get into that, because here's the way I look at it. When it comes to the markets, and you can just see from the banking crisis that's going on right now, regulations fail because they're not enforced. And the reason that you have problems is because people don't enforce fiduciary responsibilities to stockholders and the companies. So a lot of stuff is, you don't know all the time, is the accounting right? I mean, when I first started my trading career, I remember when they had the accounting scandals back in the early 90s with all the big accounting firms nationally. And then later on, you had a ratings thing where the companies that rate the stocks, you know. So now, most of the times the numbers are right. Not everyone is out there creating malfeasance, but price is price. And that's always what it also comes down to, is that I don't care what your earnings number is. I don't care what your opinion is. that matters. Are you making money or are you losing money? And price is what indicates that. So using analysis that way and the market, looking at the market that way, that's what I use. I mean, I look at their earnings. Like for instance, if you look at just the numbers, DraftKings right now should be 3-4 times its value. I mean, how do you have a company that keeps on bringing in more and more revenues, but becomes less and less profitable, and all they are is a video booking agent? So that means that they're bleeding money somewhere, and it's either through excessive marketing or the board's taking all the money. So it's just that simple, especially because with higher interest rates, they're making so much money just in interest. So that's why I don't look at those things so much. What do you think about risk on any given trade? Or for what percentage do you think of risk? Well, now the biggest thing is for your capital base, you never want to risk more than upwards of 3% of your capital on any one trade, 5% max. So that's something you need to look at right there as far as how many trades or what trade, how much capital allocation you can have per trade. Then once again, if I'm going to get, like, for instance, the last example, and I'll end on this one, was the Japanese candlestick pattern thing. So for instance, on one, I can give you one last real quick thing. I started late. I think that they can accommodate one more minute here. So right here, I'm looking for $17 here, $17.35. So it's got a dollar move. That would be a reasonable following trends, the trend thing. So right there, if you're looking for one, now how much is the risk? The risk is up here. It's $1. Now we know that's actually the cost of the option. So the cost of this put, let's go back to what it costs for that put. So for the for the ARCC, where's the ARCC put? It was 645, so it's down. Okay, so yeah, a $1 move, you'd be looking to be making that in that regards, but see, it's only a short time that we're looking for. Yeah, that's a little bit more than a 1-to-1 ratio, but see, we're not looking, if it was a stock, it'd be a different story, because it's an option, you're getting more, you have more time. You have time and flexibility. You can only lose so much as well also. So that's something you have to take into account too. Now, if you're trading just a stock, absolutely, you got to go with the higher margins. If you're trading a signal for a short amount of time, which we're doing with these, then you can cut it back a little bit, where you're looking, because that if it gets to that $1 mark, you retain all your capital as well, so you have to look at the total gross number on that one for what you pull back when you from what you put into it. And one last one, either move your cursor or not talk. Okay, you don't have enough bandwidth. Okay, so that's what it is. Thank you. All right, well, with that, actually, now I have to move the cursor back to get the PowerPoint up for Gina. So give me 1 second if I can there we go.
Okay, great. Well, I'll just wrap it up real quick then. Thank you, Teddy, so much. We really appreciate it. And that was very interesting and informative. And just a few reminders for everyone before we go. At eOption, we're always here to help you with your trading. And if you have any questions at all about anything that was presented in this webinar today or any of the trading strategies or resources, we're here for you. So please feel free to contact us. You can send us an email at support@eoption.com, or you can call us anytime and talk to someone on our trade desk at 888-793-5333. Again, 888-793-5333. And just to touch on a few points that Teddy brought up, a question was asked on what resources there are to find stock and to find trading ideas. And at eOption, we have a couple. I just wanted to run through those with you real quick. We do offer some free screeners. So we have 15 predefined screens, as well as you can choose from 60 criteria to do your own searches. So you can find stocks that pay the highest dividends, whatever you're interested in. You can set the parameters and find the stocks that fit your needs. We also have a feature where you can put in and find stocks that are optionable. So if you'd like to trade options on them. We also offer a tool called Options Play. It's our free tool that demystifies option trading. It's normally $500 a year, and we offer that free to all of our customers. And basically what that does is it scans thousands of stocks daily, and it highlights option trades opportunities for you and walks you through that. So that's great. We have beginners use that, and we have advanced option traders use it as well. So we encourage you to go to our website and check that out. There was also a question on earnings and fundamental analysis Teddy touched on. And so we do offer some features on our website. We have breaking news. We also offer unlimited free research reports. So you can type in whatever stock you're interested in and it'll give you a full analysis. And also, the analyst highlights features and what to look out for. So that's also a wonderful resource. So also, I want to point out, if you look at the screen, our next webinar, so it's part 2 of Teddy's webinar today. So this is, it's called Option Strategies and Technical Analysis, part 2. So if you can mark your calendars, that's Wednesday, May 24th at 1 p.m. Central Time. So we hope you'll join us for that. We know we had a few technical difficulties today. And so again, if you have any questions, we're here for you. And this will be on our YouTube channel, most likely by tomorrow. So if there are parts you'd like to revisit, or if you have any questions, you can always contact us. So with that note, thank you again for your time. We greatly appreciate it. And we hope you have a wonderful afternoon. Bye now.